It began on a night that looked completely ordinary. Manhattan was illuminated, steady, and composed, as if nothing in the world could disturb its rhythm. Inside the financial district, the machinery of global capital continued to operate. Traders studied screens, numbers moved, conversations stayed measured. Hands typed, phones rested beside glowing monitors, charts fluctuated within normal ranges. Everything suggested stability. The towers stood unchanged, glass reflecting light, steel holding firm, no visible crack in the structure. Across oceans, markets were connected in silent synchronization. New York, London, Tokyo, a network stretched across the planet. Beneath the surface, data moved through servers and cables. Millions of transactions, thousands of agreements, all flowing without interruption. On the screens, indices shifted slightly. Nothing unusual, nothing alarming. Just another cycle in an endless system. Employees walked through corridors carrying coffee and folders, focused, professional, unaware that the ground beneath them was already unstable. Conference rooms stood empty for the moment, chairs aligned, tables polished, waiting for decisions not yet made. Television anchors spoke in calm tones. Markets were under pressure, they said, but pressure was nothing new. The opening bell had not yet rung. It hung motionless, suspended between routine and rupture. As dawn approached, the skyline brightened. Lights still burned in office towers. The city prepared for another day. One building in particular stood illuminated against the morning sky. Powerful, established, untouchable. Inside, desks remained orderly, screens still active. The last quiet moments before history shifted. Within hours, that normality would fracture, and the collapse of a single institution would expose the fragility of the entire system. Lehman Brothers did not begin as a bank. It began in a young and expanding America, an economy built on trade, distance, and physical goods, a country still defining itself. 3 immigrant brothers arrived with limited capital but precise ambition. They understood something fundamental. In a growing nation, intermediation was power. To stand between buyer and seller was to shape the flow of opportunity. Their early business revolved around cotton, a raw commodity that fueled industrial expansion across continents. They did not merely trade it, they financed it, structured it, connected producers to markets. From the beginning, they operated at the center of exchange. As railroads expanded and steel bridged distances, Lehman evolved alongside the infrastructure of a nation. Industrialization demanded capital, capital required organization, and Lehman positioned itself where money met momentum. By the early 20th century, the firm had moved decisively into finance. Wall Street was no longer a street, it was a system, and Lehman became one of its durable components, quietly embedded, structurally relevant. Decades later, the institution had transformed into a modern investment bank. Trading desks replaced trading posts. Algorithms replaced ledgers. But the principle remained identical: control the flow of capital. By the early 2000s, Lehman was globally interwoven. New York connected to London, London to Tokyo, Tokyo to Hong Kong and Frankfurt. Its balance sheet extended beyond borders. Its obligations traveled instantly. The firm was not symbolic. It was systemic. More than 25,000 employees, billions in assets, deep counterparty relationships across continents. Lehman was part of the architecture. Inside its executive rooms, confidence was not theatrical, it was analytical. Risk models were refined, exposure was calculated, volatility was quantified. The belief was clear: risk could be measured. Complex derivatives layered obligation upon obligation. Securitization transformed loans into instruments. In theory, diversification reduced danger. In practice, complexity concealed concentration. At the center of this expansion stood housing. American suburbs multiplied. Credit became accessible. Home ownership surged. Prices climbed steadily, reinforcing collective confidence. Mortgages were bundled, sliced, and sold. Risk was redistributed across investors worldwide. Each signature on a document fed a larger machine, a machine that appeared mathematically sound. But leverage magnified everything. Returns increased rapidly. So did vulnerability. By the mid-2000s, Lehman's leverage exceeded 30 to 1. A narrow foundation supporting enormous weight. Profits validated strategy. Bonuses expanded. Success reinforced belief. And belief hardened into certainty. Internally, the system felt mastered, yet the stability depended on a single assumption: that housing prices would not fall significantly, that liquidity would remain abundant, that markets would function normally. They would not. You couldn't see it. You couldn't touch it. And yet it was working constantly. A system built on capital, trust, and mathematical assumptions, interlocking gears of credit, risk, and return. It appeared precise, controlled, unstoppable. Money was moving faster than ever before, in fractions of a second, from New York to London, from Frankfurt to Tokyo. Capital was no longer tied to a place. It was a current, and that current grew stronger every year. After the dot-com bubble burst, central banks around the world lowered interest rates. Money became cheap. Credit became accessible. Investment suddenly seemed safe again. No one forced banks to take more risk. The lower interest rates fell, the less attractive safe assets became. And when safety no longer generates returns, the search for yield begins. Investment banks competed directly, quarter after quarter. If you stagnated, you fell behind. If you grew, you gained market share. Return became the visible measure of strength. And strength had to be demonstrated. On the trading floors, risk wasn't abstract. It was quantified. Models calculated probabilities. Algorithms measured uncertainty. What can be measured feels controllable. Mortgages were bundled, sliced apart, repackaged. Individual loans were transformed into complex securities. The risk did not disappear. It was redistributed. Rating agencies evaluated these products. Many received the highest possible grade, AAA, a symbol of safety, of stability, of reliability. And trust was the most important currency in the system. Mathematical models simulated extreme scenarios. They calculated default probabilities, but they relied on historical data, and history rarely repeats itself exactly. At the same time, housing prices kept rising. Year after year, homes became more expensive, loans became larger, the market seemed to confirm every assumption, rising values were treated as proof of stability, lending standards began to erode, income verification became less strict, adjustable rate mortgages became common. As long as prices continued to rise, the risk felt theoretical. Debt increased at every level. Households borrowed more. Banks expanded their balance sheets. Leverage amplified returns. And returns validated the model. Inside Lehman Brothers, confidence remained high. The firm was historic, experienced, globally connected. Risk was calculated, diversified, structured. At least, that was the internal assumption. But beneath the surface, the system was highly leveraged. A small decline in asset value could trigger disproportionate consequences. The narrower the foundation, the taller the tower. And the tower kept rising. Then individual mortgages began to default. At first isolated, statistically explainable, but the models had underestimated rare correlations, and rare events began occurring more frequently. Doubt began to surface in the markets. Credit spreads widened. Liquidity became selective. No one spoke openly of collapse, but trust reacts quickly. The global financial network began to tighten under pressure. Every bank was connected to another, through credit, through derivatives, through mutual confidence. As long as all institutions remained solvent, the system functioned. But if one node weakened, uncertainty spread outward. Nothing had collapsed yet, but stability was no longer guaranteed. And in that moment, the escalation began. Something changes, not loudly, not dramatically, just a subtle shift in rhythm. The system is still standing, but it no longer feels stable. Prices begin to move faster. Small fluctuations turn sharper. Phones ring more often. Conversations shorten. No one says it out loud, but everyone feels it. Liquidity, the invisible force holding everything together, starts to thin. Capital hesitates, flows slow, unevenly, and hesitation spreads faster than panic. Office lights remain on deep into the night. Behind glass walls, decisions are being recalculated. Risk models are reopened. Assumptions quietly questioned. Contracts once seen as assets now look complicated. Layer upon layer of obligations. Promises built on other promises. Too interconnected to untangle quickly. The structure still stands. Tall, impressive, But at its foundation, small fractures begin to appear. Almost invisible, yet undeniably real. Confidence fades before collapse ever begins. Ratings hesitate, certainty becomes probability, and probability becomes doubt. Across the globe, financial networks flicker, connections that once pulsed steadily now blink irregularly. Trust is no longer automatic. On trading floors, the noise softens, not because things are calm, but because everyone is watching, waiting. The city never sleeps, but tonight it feels different. Lights remain on for reasons no one wants to explain. Charts begin to swing violently, up, down, up again. Volatility is no longer background noise. It is the main signal. Pressure builds silently. No explosion, no alarm. Just increasing strain inside a system stretched too far. Executives gather, voices controlled, body language rigid. The room feels smaller than before. Phones ring without answers. Corridors echo. Time moves forward, but solutions do not. Financial hubs dim one by one, not shutting down, just losing intensity. Like a grid running out of power, complex securities begin to shift. Layers no one fully sees start moving against each other. The math still works, barely. Faces grow tired, eyes stop blinking as often, screens freeze for a second too long, and every second matters. Inside the system, pressure pushes outward, but the walls are not breaking. Not yet. Dawn approaches. A new day begins, but no one feels relief. Data moves faster than human thought. Numbers blur into abstraction. Meaning disappears inside velocity. The network pulses rapidly now, like a heartbeat under stress. Unstable, irregular, alive, but struggling. Chairs sit empty. Screens glow unattended. Silence replaces noise, and silence feels heavier. Morning light cuts through boardroom blinds. Decisions hang in the air. Every option carries risk. Every delay carries more. The system vibrates under pressure, still intact, still standing, but no longer secure. Liquidity evaporates faster now. Buyers hesitate. Sellers multiply. Balance becomes fragile. Exhaustion replaces confidence. No one is shouting, but everyone understands how close the edge feels. Connections dim simultaneously, not isolated failures, but synchronized weakness. The scale tilts, stops, tilts again. Equilibrium becomes temporary. Calls go unanswered. Messages stack up. And uncertainty compounds faster than debt. Outside, the building still stands tall, glass reflecting a city unaware of how thin the margin has become. Inside, doors remain closed, discussions grow shorter, options grow fewer, documents cover tables, calculations repeated, outcomes narrowed, time shrinking. The structure bends, not breaking, but bending. Morning light spreads across the city. It looks normal. It is not. Screens glow in dark rooms. Markets still open. Confidence no longer present. The system is stretched to its absolute limit. Every connection under strain, every assumption exposed. And for a brief moment, everything holds. It is still dark over New York. The city lights are on, but something feels suspended, like the air is waiting. Wall Street is empty. Rain still clings to the pavement. The morning has not begun yet. The building stands exactly where it always has. Glass, steel, flags barely moving. Nothing looks broken. Nothing looks different. And yet, inside, everyone already knows. The doors turn slowly. One person enters, then another. No crowd, no rush. Just quiet steps into a place that no longer feels the same. The lobby is polished, orderly, still. A guard watches the entrance, not tense, not relaxed, just present. An elevator closes, a reflection in the mirrored wall, a face avoiding its own eyes. No words spoken, only the soft mechanical hum of a movement upward. The trading floor is not loud, not yet. Screens glow in the dark. Chairs wait, one slightly out of place, as if someone left quickly and never returned. A screen asks for a login. The cursor blinks, steady, unbothered, waiting for a name that still belongs to someone. The hallway stretches forward, lights half dimmed. Footsteps echo faintly. No conversations, only the sound of breathing in a building full of people. Hands hold a coffee cup. A slight tremor. The lid clicks softly against paper. It is just another morning. Except it isn't. Employees stand together, not speaking, not checking phones, just standing. Tired suits, long night faces, eyes that did not sleep. The clock moves forward, second by second. The sound feels louder than usual. Another clock shows the same time. Nothing has stopped, and yet everything has. A conference room waits, chairs aligned, notepads untouched. Morning light enters quietly. The room does not know what it is about to hold. A figure stands at the window, looking out at the city, face unseen, shoulders still. The skyline reflects back without answers. A badge clicks into place, metal on fabric. A small sound in a large silence. Identity confirmed, access granted. For a few more hours, emails continue to arrive, unread, stacking quietly. Another notification appears. The world is moving. Inside this building, time feels slower. An empty chair turns gently, then stops. No one touches it. No one needs to. Absence can move on its own. Morning light finally reaches the facade. The glass reflects a brighter sky. The city wakes up. Cars move. People walk. The building remains still. Behind the glass, figures stand without motion. Doors closed. No one rushing. No alarms. No noise. Just a morning when everything stopped. It is Monday, September 15th, 2008. Dawn breaks over lower Manhattan. The sky is pale. The city moves, as it always does. At 7:45 a.m., Lehman Brothers Holdings Incorporated files for Chapter 11 bankruptcy protection. No announcement, no ceremony, just a legal submission. Inside the headquarters on 7th Avenue, employees sit at their desks. Most have already heard the rumors over the weekend. Now, the internal confirmation appears on their screens. The firm has officially entered bankruptcy. Conversations stop. Printers begin running continuously. Court documents, asset schedules, liability disclosures. The filing lists approximately $613 billion in assets, roughly $639 billion in liabilities. The numbers are precise. The consequences are not. In a conference room, senior executives sit around a polished table. No one raises their voice. There is nothing left to negotiate. The decision was finalized overnight. A folder closes. The meeting ends. The bankruptcy petition is stamped and entered into the federal court system. It becomes public record. At that moment, Lehman Brothers becomes the largest bankruptcy in United States history. The firm has existed for 158 years. It now exists as a case number. A final signature is placed on supporting documents. The pen moves slowly. There is no hesitation. The legal structure that once protected the institution is now dissolving it. Procedure replaces power. The filing is processed by the United States Bankruptcy Court for the Southern District of New York. The process is routine. The scale is not. News agencies receive confirmation within minutes. Bloomberg, Reuters, the Associated Press. The headline circulates globally. Lehman Brothers files for bankruptcy. Television broadcasts interrupt scheduled programming. Financial analysts speak in controlled tones. One phrase repeats across networks. Systemic risk. Trading floors in New York react immediately. Phones ring without pause. Orders are revised. Market indices begin to decline sharply. There is no panic yet, only acceleration. Within hours, the reaction spreads across time zones. London opens lower. Frankfurt follows. Asian markets adjust in anticipation. Interbank lending rates begin to rise. Liquidity tightens. Pension funds calculate exposure. Insurance firms review counterparty agreements. Money market funds reassess risk levels. Institutions that never held Lehman stock discover they are connected anyway. Inside the building, division heads receive final instructions. Certain departments will cease operations immediately. Employees are informed that access will be restricted. Some positions are terminated on the spot. Personal belongings are placed into cardboard boxes. Framed photographs, desk plants, notebooks, identification badges are electronically deactivated. The system recognizes them no longer. Security personnel stand nearby, calm, professional. There is no shouting, no visible protest, only compliance. Television anchors describe the event as historic. Government spokespeople release brief statements. Officials confirm they are monitoring the situation closely. No rescue packages announced. Financial contracts linked to Lehman begin activating clauses worldwide. Credit default swaps trigger settlement calculations. Clearinghouses demand additional collateral. Trust between banks weakens further. On the Lehman trading floor, activity slows. Screens display volatile movements. Then some go dark. Chairs remain pushed back from desks. Employees exit the building in small groups. They move quietly into the morning crowd. The company name remains mounted above the entrance. It has not been removed. Credit markets begin to freeze. Banks hesitate to lend to one another overnight. Short-term funding costs increase sharply. Confidence declines faster than capital. In Washington, emergency meetings begin. Treasury officials consult with the Federal Reserve. Across the Atlantic, European regulators hold similar calls. The issue is no longer isolated. By midday, major stock indices record steep declines. Volatility spikes. Investors move into cash and government bonds. Risk tolerance contracts globally. Inside empty offices, lights are switched off one by one. Entire teams cease to exist within hours. Email accounts are disabled. Phone lines fall silent. By early afternoon, Lehman Brothers is no longer functioning as an investment bank. It is a bankruptcy proceeding, a balance sheet in court, a system that has broken officially. Within minutes, the shock travels outward through trading systems, clearing houses, and overnight funding markets. It moves faster than aircraft, faster than headlines, faster than governments can respond. Canary Wharf turns red within seconds. Screens flash downward arrows. Liquidity evaporates. Confidence disappears first. Short-term loans, derivatives, credit default swaps. When one node fails, every counterparty recalculates risk. Connections begin shutting down. Executives review exposure sheets. Balance sheets are re-examined line by line. Interbank trust weakens. Funding costs rise. New York, London, Frankfurt, Tokyo. Correlation approaches 1. Diversification no longer protects capital. Retail depositors follow the news. They do not study derivatives. They respond to uncertainty. Uncertainty alone is enough. Letters of credit finance, cargo ships. Working capital keeps ports moving. As lending tightens, movement slows. Orders are postponed. Expansion plans suspended. Machines power down in sequence. Industrial output contracts. Employees exit buildings under camera flashes. The story is no longer about one firm. It is about the system. Lawmakers and Treasury officials convene emergency sessions. Stability becomes the priority. Ideology becomes secondary. AIG deeply intertwined through credit default swaps. Its failure would multiply losses globally. The government intervenes. Different languages, same message. Financial crisis, global recession risk, system under strain. ATMs delay transactions as liquidity tightens. Customers press keypads repeatedly. Trust in institutions weakens further. Residential developments remain unfinished. Credit for real estate evaporates. Property values begin declining sharply. Foreclosure notices increase month by month. Housing, once considered stable collateral, becomes a source of systemic loss. For sale signs multiply. Prices fall. Equity disappears. Households reduce consumption. Red dominates digital boards. Volatility spikes. Global markets move in synchronized decline. The U.S. dollar strengthens, then weakens. Capital seeks safety. Safe assets become crowded trades. Investment conferences are canceled. Corporate expansion plans freeze. Globalization slows in measurable increments. Retail stores close earlier. Revenue uncertainty replaces growth forecasts. Local economies feel global stress. Federal Reserve, European Central Bank, Bank of England. Liquidity facilities expand. Interest rates are cut rapidly. Swap lines between central banks are activated. The objective is stabilization. Asset purchase programs begin forming. The scale exceeds previous crises. Monetary policy enters new territory. Capital injections are prepared. Governments assume private risk to prevent systemic failure. Public debt rises. Hiring freezes spread across sectors. Job applications increase. Confidence declines in parallel. Moves are postponed. Education plans reconsidered. Economic contraction becomes personal. The language becomes definitive. Forecasts turn negative. Fiscal expansion competes with deficit concerns. Political divisions sharpen. Economic policy becomes contentious. Demands for accountability grow louder. The crisis shifts from financial to social. Trust in institutions erodes. Security presence expands. The economic downturn reshapes civic stability. Activity returns slowly, but leverage ratios are lower. Risk appetite remains cautious. Compliance departments expand. Capital requirements tighten. The system recalibrates. Others merge. Brand names vanish from facades. Financial concentration increases. Servers continue processing transactions. Clearing systems operate. The architecture survives. Funding channels narrow. Regulation thickens. Risk becomes more centralized. They speak of stability, resilience, reform. The tone is controlled. The scale of intervention is historic. Voting boards illuminate. Oversight increases. Complexity grows. Foot traffic returns, markets stabilize, but expansion is measured, capital standards strengthen, transparency requirements increase. The system becomes heavier. The shockwave is no longer expanding. The system did not collapse entirely. It absorbed the impact, but it changed, and the cost of that change is still being measured. On September 15, 2008, the headline became permanent. Ink on paper, a recorded event. Lehman Brothers files for bankruptcy. The date remains fixed. The interpretation does not. Courtrooms processed the case. Filings were reviewed. Obligations sorted. Assets liquidated. Procedure moved forward. Accountability remained less defined. Thousands of pages were archived. Depositions, internal emails, risk assessments. The documentation is complete. Understanding is less certain. Executives testified. They described market conditions, liquidity pressure, unforeseen acceleration. Intent was debated. Responsibility was distributed. Congressional hearings examined systemic failure. Questions were asked repeatedly. Why was leverage permitted at that scale? Why were warning signs minimized? Answers varied. Capital requirements increased. Stress testing became mandatory. Liquidity ratios were standardized. The framework changed. The incentives evolved more slowly. Trading floors today appear orderly. Risk models are more complex. Compliance departments larger. Volatility is measured in real time. Stability is assumed carefully. Algorithms now execute decisions in microseconds. Liquidity is provided by code, withdrawn by code. Speed has increased. Human reaction time has not. Markets recovered. Indices surpassed previous peaks. Capital returned. The long-term chart trends upward. Recovery is visible. Memory fades gradually. New headlines replace old ones. Emerging risks. Geopolitical tension. Debt ceilings. The vocabulary changes. The structure remains interconnected. Financial districts expand again. Glass towers reflect steady daylight. Balance sheets grow. Confidence rebuilds. Measured, cautious. Business agreements resume. Capital flows across borders. Credit markets function. Trust returns incrementally. Trust is rarely visible. Its absence is. Central bank balance sheets remain larger than before the crisis. Emergency tools became permanent instruments. Liquidity facilities exist in standby. Preparedness is institutionalized. Risk is quantified differently now. Spreadsheets calculate exposure. Scenarios simulate stress. The models assume rational behavior. Markets do not always comply. The Lehman name no longer appears on skyscraper facades. It remains in academic papers, in regulatory discussions, in archived boxes, an absence recorded in structure. Wall Street continues operating. Orders execute. Trades settle. Employees arrive each morning. The street sign has not changed. From orbit, the planet appears stable. City lights glow consistently. No visible fractures. Systems rarely reveal strain from a distance. Time moves evenly. Seconds pass without volatility. Stability often feels permanent while it exists. Occasionally, markets fluctuate sharply. A brief spike, a temporary decline. Most corrections resolve quickly. Confidence resets. Traders observe indicators. They assess risk in real time. Small signals appear. Small signals disappear. Patterns are interpreted differently by each participant. Government institutions remain active. Regulators monitor liquidity levels. Capital buffers are reviewed. Oversight has expanded. Certainty has not. Each evening, office lights switch off. Buildings empty. Cleaning crews replace executives. Systems continue running overnight. Financial corridors remain intact. Data flows continuously. Contracts renew automatically. The architecture persists. It adjusts quietly. From space, the lights remain steady. No shockwave expands outward. No visible collapse unfolds. The system continues. Whether it is stronger or simply more complex remains open.